Look, it's been obviously a very interesting time in the markets the last few weeks, and it's a good time to have another look at AGL and ORG. So both companies are still on holds, but I just wanted to talk you through some of the relative performance. So AGL, since about mid-February, fell 15% versus 8% for the utilities index, while Origin's down 24% against 31% in the energy index. So it's an underperformance by AGL, which is interesting, and it actually brings the share price down closer to my buying range. I'm not quite there yet, but there were moments yesterday where on its lows, AGL was actually looking reasonably attractive. So how they stack up in terms of gearing, AGL is still moderately geared at 26%. The gearing has increased a little bit given that ongoing share buyback program is eating up some of their cash. Origin has done quite a bit of heavy lifting over the last few periods and has actually gotten its gearing down to 26%. And APLNG is also moderately geared. That's its LNG-focused subsidiary at 29%. So still a reasonably strong balance sheet. But the differences between the companies are that obviously AGL is still very heavily focused on the domestic electricity market. It's a vertically integrated generator retailer. Whereas Origin is a blend 50-50 roughly between a similar style of business, heavily vertically integrated with APLNG as its oil-exposed subsidiary. The thing that really stands out to me at the moment is there aren't likely to be any surprises in the electricity market over the next little while. I think coming into the full year result, in terms of prices anyway, it should be fairly predictable. Barring any kind of disastrous breakdown at one of AGL's plants, I think we can be pretty confident in their guidance and the dividend. I'm forecasting a 92 cent per share dividend, which would be pretty close to a 5% yield at the moment. So looking a lot more attractive than the 4% yields we're looking at pre-results. Origin, interestingly enough, I spoke to them yesterday, are also claiming that they're going to likely maintain cash flows. APLNG is expected to continue to meet its distribution guidance of between $1.1 and $1.3 billion to Origin. But you've got to bear in mind that next year is a very different picture. There's that lagged impact that Adrian talked about with LNG contracts, whereby the full impact of the recent oil price drop is probably not going to be really felt until next year. So that is the real stark contrast for me, is AGL should have a relatively stable year next year. And in fact, there is that one-off boost from the Loy Yang insurance claim. So AGL wore that hit to earnings this year and is expecting to claim that back next year from their insurers. That's about $90 million or somewhere around 10% of net profit. So as I said, it's still a little bit above buying territory for me, AGL. But it is certainly getting closer and is dipping below that at times during the market. So I'd certainly pay attention to it. Wouldn't necessarily pin your ears back and jump in, but it could be reasonably attractive if prices keep dropping off. Origin, on the other hand, as I said, coming into the result, should have, well, according to the company, should have fairly consistent cash flows. But next year is the big question mark. If we're looking at two low quarters of oil prices along the lines of what Adrian was describing yesterday, then I think that will really hit the dividend hard. So, as I said, give it a watch, put on the radar, and if prices dip down further on AGL, it might be time to have a look.